Good afternoon or good morning over there, Puru. How's it going?
Yeah, good, thank you. How are you?
I'm doing well. Okay. Sounds like this time it's going to be easy. Your sound quality is good. Spaces have finally now they work. It's 2 years later, so they work actually both on desktop and on the phone, which is nice. They've really gotten their act together. Do you want to give it just a minute here as we let people come in?
Yeah, for sure. We can wait
Okay.
for a while.
Okay. Perfect. We're just going to give it a minute to the people in the audience. If you are going to have questions and stuff that you want me to ask, feel free to drop those into the Spaces chat. If you are so kind, please do share out the space as well so that our audiences can come together and listen in. It's going to be an exciting one. I do see you shared out about an hour ago the other one. If you want to share out the current link, Puru, one of the ways it lets you do that is if you're in the space and you click on the bottom right area, there is a little kind of like a comment signal or something like that. It'll essentially take you to the post. When I open up the space, it makes a post to my timeline, and you can just share that, which
Oh, okay, hang
yeah,
on a second. I'll just
there
do
you
it
go.
now. You'll just bear with me a second.
No problem. No problem.
Okay.
So people were excited for this. I've got a guy who's been in my DMs for 2 years asking me when you would come back, and he checks in every couple of months, and he was very excited. So
That's nice.
people have not forgotten.
Okay, I'm just posting this now. 1 second, please.
Yeah, take your time. All right, everybody. Evan, thank you for coming on up. Should be an exciting one as we dive in here to a few things. We'll be talking about, of course, the markets, opportunities in the markets, Alpha Target, which I'll go ahead and I will pin that to the top of the space so people can be aware of that as well. And we'll get started in just a minute. See Dylan in the crowd. Thanks for being here. We'll definitely, I'm sure, talk NVIDIA. I think that's going to be definitely a piece of this. See some people already asking about that. Cool.
Okay, done.
All right, perfect. Okay, let's go ahead and jump right into it then. So welcome in everybody to our evening's discussion covering the market and opportunities in 2024, as well as Alpha Target, which is Puru's fund, which will, or research firm, which we'll be diving into here a little bit more. Just to kick things off, Puru, I'm sure most people that are in the audience are familiar with you, but for those that aren't, can you catch them up on who you are, what you've been doing? It's obviously been a couple of years since we've had a space, so it might be
Sure.
good to get a refresher here.
Okay, I mean, basically, I ran investment management firms here in Hong Kong. So I was the founder of two SFC regulated money management firms here. The first one I co-founded with two business partners in 2001, and I stayed there for 4 years. So we grew pretty rapidly. We grew to 150 people working for us. And then basically I left for a couple of reasons from that firm, and I set up my own boutique money management firm in 2005 in Hong Kong. And I managed money for family offices, companies, high net worth individuals, and so forth. So we ran different discretionary mandates for them. I did that for 11 years. I was also a regular guest on all the media, BBC, CNN, Bloomberg, and CNBC, etc. I had monthly columns that I used to write for magazines and newspapers here in Hong Kong. So I did all of that for sort of 15, 16 years. And then in 2016, I basically retired from the business after doing this for 15 years, running my own firms. And then my firm was actually acquired by a listed asset management company here in Hong Kong. So for the last sort of 8 years or so, I've just been investing my own money and just running this Twitter account as a public service, just sharing my ideas, thoughts, and stuff like that. My portfolio holdings for a number of years, I even shared my performance on a monthly basis. That I got, attacked by trolls saying that this guy's posting fake performance. He's a con, he's this and the other. So I basically decided, I didn't need that kind of grief in my life, especially when I wasn't even, charging anybody anything or running a service. So I basically stopped all of that I think about 2 years ago. And over the years, I've received a number of requests on an ongoing basis from people from all over the world saying, can you launch some sort of ETF, manage our money for us? Can you set up a fund? And I've always politely declined it. And I said, look, I've done it for 15 years. I'm now 47 years old. I don't really want to go back to that sort of hectic, stressful life and existence any longer. So I thought, long and hard of how I can actually, do something meaningful, or at least try and do something meaningful, to empower investors at a retail level. Because, since I've been running my own portfolio, I've realized how difficult it is to obtain good quality research and insights if you're a retail investor. If you run a money management firm, then, you get brokers and stuff and banks throwing their research at you because they want you to basically trade through them and get your business and commissions and so forth. But if you are, a private investor, unless, you're managing hundreds or millions or whatever, for different accounts, for the vast majority of people, it's very hard to get access to good quality research. So I thought about this long and hard, and I thought, how can I actually do something to basically add value to people? Because obviously on Twitter, you can't really say much for a variety of reasons. Number one, there's a restriction on the number of words you can type. And, obviously, if you're communicating with such a wide audience, I've got like 350,000 odd followers now. So, it's irresponsible on my part to actually say too much about any given company and so forth. So I thought, how can I add value and do something to help people and empower investors? So I thought about this long and hard, and I had a discussion with a few other experienced investors and so forth, and analysts. So I finally decided to set up Alpha Target, which will basically be a research firm which will provide institutional grade, high quality research, which is not generally available to retail investors. So we're going to basically run a service now which would, not only cover the research on the most disruptive companies in the world globally, we would also give people the tools and the resources so they can manage their own portfolios, including sharing our proprietary hedging indicators with them in real time. And we will, walk the talk. So we will invest our own capital in the companies that we've selected in the portfolio, which we are doing in any case. And then when we will make any changes to the portfolios, for example, if we raise some money because the stocks run up too much, or if something's come down and if we add to a position, or if a new exciting opportunity comes along, then we will basically we will invest our own money in it, and then we will send out an alert to our subscribers of our research so they can actually keep track of what we are doing with our own money. We will also send out like a monthly report, which will be a comprehensive report, tens of thousands of words with a deep dive, a succinct SWOT analysis, sort of deep dive research covering all qualitative and quantitative aspects of any given company in our portfolio. And we will have a run through a research report on all of those companies, plus a stock market analysis, hedging indicators, and so forth. We will also produce weekly updates every Monday to cover all the news flow from the prior week. And I'm very excited about this venture simply because I'm putting together a great team. So I've basically recruited two highly experienced analysts already who've already started working. There's another person who's the third person who's basically also working, who's also been recruited, and he's going to join us. And I'm also in talks with a very experienced buy-side analyst who used to run money for a big multi-billion-dollar hedge fund in the US. So we are in sort of advanced discussions now, and hopefully, I think more likely than not, he will also come on board and join the firm. So very excited. We're really looking forward to, providing high-quality research which people can actually rely on and use as a tool to manage their own portfolios.
Very cool. So this is a really unique opportunity. If you're in the audience, listen in as we'll talk a little bit more about Alpha Target, which is going to, I suppose, democratize that access to institutional grade research for the everyday investor. Now let's talk a little bit about the market, right? So obviously you have a unique approach to investing and you're translating that over into this firm with your research, but let's talk about the approach first. How has your approach changed over the last couple of years within the market? And perhaps you give us an update on your current portfolio and why it is as it stands.
Yeah, for sure. I mean, basically one of the biggest revelations for me, over the last 2 years has been that, how crazy the markets can become. So, when things are, euphoric and everybody's jumping up and down and everyone is, thinking, wow, everything's great, then stocks go up a lot more these days than they used to 10 years ago, 15 years ago, and then the valuations just get chucked out of the window. Nobody really cares about the valuations. Stocks move up and down a lot these days, so the volatility has become insane. If you have great earnings, the stock goes up 15, 20% within a couple of minutes after market or pre-market. Similarly, if there is a slight, disappointment or miss in the earnings, the stock goes down 15, 20, 30% within minutes. I mean, this sort of move used to happen over a period of months several years ago. So everything has become super fast and turbocharged because of technology and access to information, and also because of the discount brokers and the fact that people can just press buy and sell buttons and trade themselves, as opposed to, calling a broker or a human being and paying 1% commission. Those days are long gone. So because of technology and how quickly information is now available and how quickly it travels, the markets have become very volatile, very, very quick. And the biggest thing has been, if you see what's happened with all the growth stocks over the last, 3-4 years or so, first of all, they went, parabolic. They went up, 5x, 10x within 15 months or so because of QE and zero interest rates. And then when the Fed changed its tune, then these stocks came down 70, 80, 90%. So one thing is clear, and which has always been clear in my mind, it became even clearer to me, that this buy and hold for the long term is all nonsense. This only works in theory. And again, I've been pointing this out repeatedly. If you look at the history of the stock markets, forget about individual stocks for a minute. If you look at the history of the stock markets globally, there is no stock market in the world which has gone up consistently over a period of time, not one. So, most people don't realize that stock markets in general, they go through secular bull markets and bear markets. So when you have a secular bull market, like in the US, for example, from sort of 1980, 81, 82 to 2018 year run where everything went up several X, then people get super excited and they think that these times are going to last forever. And then, you have a nasty secular bear market. I mean, just to refresh the listener's memory, because, I've been doing this professionally for 25 years and I've been around the block. So in 2000, the S&P in March 2000 was at 1,550. In 2003, the S&P went down to 750. So it basically lost half of its value. The NASDAQ went down 80, 90%. A number of these high-flying growth stocks went down 80 to 90%. And then we had another rally because back then Greenspan basically lowered interest rates to zero to try and reignite another bubble, which he succeeded. There was a massive housing bubble and a subsequent crash. So, we had zero interest rates, and then we had another party. Stocks went up from 2003 until 2006, 7, October 2007. The S&P doubled, went back to 1,500, 1,550. And then basically the global financial crisis hit. And then the S&P fell from 1,550 to 666. I still remember the number, 666 in March 2009. So that was a huge decline. And then, it took 13 years in total for the S&P to break to a new high. If I'm not making this up, anybody can check this. 2000 was the peak. And then the S&P decisively broke above the 1,550 level 13 years later. And those who basically bought and held without any risk management, without any hedges in place, had a very painful 13-year period because, they saw their portfolio go down more than 50% on 2 occasions and not a lot of progress. And this is not the first time this has happened in the US. Previously, we had a similar secular bear market from 1968 in inflation-adjusted terms to 1982. So it took 14 years for the indices to break to new highs. And then we also had, 30, 40, 50% declines, a 150% hit, and then another 30-odd% decline in that decade. So, this notion that anybody can just buy and hold stocks forever and just everything will be great and it's a land of milk and honey, that's not how it works, unfortunately. And we are now in a position, if you look at the US has been running for the last 14, 15 years. And, the valuations are now quite stretched in America. And if you look at the emerging markets have been in a secular bear market since 2011. Some of them haven't gone up at all since 2007 or 8. So it's been a long 15-year stretch for the emerging markets where they've basically struggled and investors there haven't made any money at all. And Japan has been in a drawdown, for 30 years. It's just recently broken out to a new high. Europe has been flat more or less for the last 15 years or so. That this idea that basically gets thrown around a lot on financial Twitter, that you can just buy and hold and everything will work out just fine. It doesn't work that way in reality. And if you just buy and hold, especially a portfolio of growth stocks with no risk management in place, no hedges in place, no exit strategy, when to buy, when to sell, you're really flying in the dark, without an altimeter. You really don't have a clue what you're doing. And you will get creamed. Like most of the growth stocks went down 70, 80, 90%. Anybody who just sat through that drawdown basically had a horrendous drawdown, and it's going to take them years to recover. So these are some of the things which have really been cemented in my brain even more, looking at the craziness of the markets over the last 2 or 3 years, that unless you are an ETF investor, if you are buying indices for a 15, 20-year period, you can buy and hold. Or if you don't care about money, you've got hundreds of millions of dollars or tens of millions of dollars, and you don't care if the portfolio goes down 50, 60% and doesn't do anything for 10, 12, 15 years, then buy and hold works for you. And if you are young and if you're investing every month or every quarter into your pot, and your pot isn't very big, then buy and hold also works because you have time on your side. But if you are in your 50s or 60s or 70s, and the vast majority of your net worth is actually invested in stocks, and you don't have any money coming in, buy and hold doesn't work, and it will basically lead to financial ruin. I can guarantee you of that.
That is a pretty passionate thought there, right there, on buy and hold. And I do hear the examples that you were saying, where if you're young and you're just putting it into broad-based ETFs over time, then it's a very different situation than if you're, a little bit later in life and you're trying to invest a significant sum of money, right? So talk to me, understanding that buy and hold can be a tough situation for people that don't have time on their side, right? Don't have some of these broad-based index funds. What is appealing to you as a more, strategic investor in a market like this, which is at all-time highs, and which you seem to, have I think put into words here, don't believe that this can continue for who knows how much longer? How do you position yourself to capture more of this upside? Because we could see Nvidia rip tomorrow, right? The whole market could rip up another 10, 20%. We could also see a pullback. So how do you position yourself?
Well, I've done extensive research and studying on how the stock market has performed. Over the last several decades, I've spent over a decade studying the history of the stock market in the US and seeing, what works and what has powered those gains. Because everybody loves to talk about that 10% annualized return from the S&P going back decades. Most people don't realize that the vast majority of those returns have actually come from a handful of companies. So, I can't remember the percentage at the top of my head, so I don't want to give misleading information. But, a very small percentage of equities at any given point in time have actually powered the vast majority of the returns at the index level. And a number of companies have actually underperformed. And I did actually share some statistics several months ago on my timeline, which basically said that, I think half of the companies don't even make it as standalone companies after 15 or 20-year period. So you have to be super selective and careful of what you actually own. And I have no problem with buying and holding, but you have to buy and hold and verify. You can't just blindly say, well, I'm investing in this company, and no matter what happens, I love this company, I love the management. The company doesn't love you back. The company doesn't know that you own the stock. And management teams cheat. They become, incapable. The good people leave, the smart people leave, the management keeps turning, competitors come along, new product lines are developed, the disruptors themselves get disrupted over time. So this is not a game for passive investors. If you're going to invest in individual companies, you have to have the research and the knowledge and the insights to keep on top of your holdings and watch them like a hawk. If you want to invest and make your 10% or 8 or 10% annualized, without any headache or without any hard work, then you can simply go and buy, the QQQ or the S&P or a broad-based index tracker for the very long term and just shut your eyes and say, okay, if it goes down 40, 50%, I don't really care. But if you are after a higher return, and if you have, the inclination, some sort of knowledge and the hunger to try and do better, then, certainly that's possible by investing in businesses, because the stock market really is an average of companies, right? So you have 500 companies in the S&P. Some of them are great companies, some of them are mediocre companies, and some of them are poor companies. So if you invest in the great companies, and if those companies are basically stable, they generate a lot of free cash flow, and they basically are stable throughout the business cycle, then your returns are going to basically be better than the index. It's just common sense, because the great companies will outperform the average, which is the index. On the other hand, if you basically invest in some duds, or if you basically invest in bad businesses, then your return as an investor is going to be inferior than the average or the indices. So for the vast majority of people, if they don't have the time or inclination, just buy a diversified basket of ETFs. And I'd just like to mention, I'm not a registered investment advisor or money manager any longer, so people should take my opinion with a pinch of salt. It's just my 2 cents. I'm not giving any personal investment advice to anybody, because I don't know who's listening and what their personal circumstances are. But you can certainly try and outperform the indices by investing in great companies. So if you look at the last 20-30 years, a lot of companies have delivered mind-boggling returns, and those generally have come from the disruptive companies. So if you look at the likes of Amazon, or search in Google, or Meta, or the cloud names, or the software companies, Adobe, ServiceNow, Salesforce, and so forth. And even in the non-tech space, in the offline economy, you look at good restaurant brands, Chipotle. If you look at, even good old McDonald's continues to outperform the index. So you have to own the right businesses. So for my part, what I've been doing for a number of years, and what we will be focusing on at Alpha Target, we are going to basically, research and screen through and scan the thousands of public companies available globally, and try and find the most promising, rapidly growing, disruptive businesses, which we feel are run by exceptional management teams with long runways, and where we think that there is a defensible competitive advantage. And then we are going to basically run a concentrated portfolio of maybe 15 to 18 such businesses, invest our own capital, and use stage analysis, which is a form of trend following technical analysis, to time the entries and exits. Because one of the things which most people don't realize is that stocks usually, or not usually, they always go up in a stage 2 uptrend. They peak in the stage 3 distribution phase, where they go zigzag, and then sellers basically overwhelm the buyers, and then you have the stage 4 decline, where the sellers are in control and buyers basically give up and throw in the towel. So if you are going to take anything away from this spaces, is this, that you never ever want to own any stock in a stage 4 decline. And by a stage 4 decline, I mean when the moving average, the long-term moving average, has rolled over and is pointing downwards and is trending downwards, and the price is below that declining moving average and also trending lower. That's where you lose 40, 50, 60, 70% of your money in your portfolio. Conversely, if you invest in a stage 2 uptrend, which is when the price has just broken out of a lengthy multi-month consolidation phase, which is stage 1, and the price then rips higher, ideally on higher volume, above the decline. Now the moving average has rolled up. It has basically bottomed and is now trending higher. So the price is now above that. That's when you make your money, because in a stage 2 uptrend, price basically makes a series of higher highs and higher lows, and then the moving average basically trails that, and it points or trends upwards, and that's where you make your money as an investor or as a trader. I have yet to come across any investor or trader who has made money in stage 4 or stage 3. It doesn't exist. So the whole game is to basically try and buy stocks early on during the advanced phase, which is stage 2, and then basically riding them until the end or towards the end of the stage 2. And when you see that the dynamics of the stock have changed, and then distribution is coming in, the stock is refusing to make a new high, even on great news, it doesn't go higher. That is usually a time to be on high alert, because once the best has been discounted, stocks peak and they basically tank. And stocks don't peak when the news has become bad. Stock basically peak in advance of the news. So the stock market moves 6 to 9 months before the real economy and the news becomes obvious. So, like coming back to your NVIDIA example, as one of your listeners basically is interested in, Nvidia has had a huge run. It's gone from 100 to sort of 900. It's gone up 9x or 8 or 9x in the last 18 months. And Nvidia, although is the darling of the AI, move, it is not a recurring revenue software business. It is a cyclical, okay? And the chips business is notoriously cyclical. So when people say, "Oh, look, Nvidia's earnings are still reasonable. It's only trading at 30 times earnings." One thing I've learned as an investor doing this professionally for 25 years is that, cyclicals appear cheap near the tops. The time to buy cyclicals is when they are basically hated, when they are unprofitable and they are trading at very high multiples. That's when you buy a cyclical. And when the valuation becomes very low and cheap and they appear cheap, that's when basically these cyclicals are at peak earnings for the cycle. And the smart money is now basically lightening up. And the retail punters are buying in because, if the outlook for this business is so amazing for the next 12 to 18 months or 24 months, then why is the PE cheap? Why isn't the big money piling in? Why aren't they paying a 50 or 100 times earnings multiple? So, a PE multiple at peak earnings or around peak earnings after this huge capex move because of the data center build out, because of AI by these big mega tech companies, this is not a sustainable run. Sure, in the long run, Nvidia will do great. But at some point, and I don't know when, and neither does anybody else, at some point, there are going to be violent pullbacks, especially when the first wave of this data center build out is over. At some point, as soon as there is any whiff of bad news or slowdown, that these companies have slowed down or they are not going to build the AI data centers as fast as they were before, or they are taking a wait and see approach to try and monetize their current infrastructure, this stock is going to go down hard. I mean, I wish I could tell you when. I just don't know. I mean, for me, I've lightened up on my position. I've cut back on 40%. If we do have another big rally, towards the maybe, if this thing runs for another 12 months or so, at some point, I will be looking out of cashing everything because I don't want to be losing 50, 60% when this thing does turn. And because it is a cyclical, it will turn because these companies cannot keep buying these GPUs and these chips forever at this pace. There is bound to be a slowdown at some point.
Yeah, there's definitely going to be something that has to happen with the market. If you had to give kind of your best guess into it to somebody, let's say there's people that always ask me, I'm sure you get this question, people that aren't investors, right? They go, why is the market at all-time highs right now? Why is crypto at all-time highs? Why is everything continuing to run? What is going so right in this market? Do you think this is something which is a mistake? Is this a bubble in your eyes? You were kind of, talking about some of the bubbles early in the 2000s, and why would it be from your perspective? And if so, how, I guess I hinted at this a little bit earlier, even if something is a bubble, if you're an active investor, there's still ways to participate. So maybe I'll just pause there and get your thoughts on those few questions.
Yeah, for sure. I mean, the stock market isn't cheap by any historical evaluation measurement. However, the market has been expensive for the last 15, 20 years, since the crash of the global financial crisis. Equities in the US have been sought after by investors all over the world. And I don't blame them, because if you look at the world around today, where are you going to invest? Are you really going to invest in Russia? I don't think so. Are you going to invest in China with what's going on, with the politics and the grab, of the political situation and the corporate governance concerns people have? So, are people going to invest in China with their worsening relationships with the US, which is the world's biggest economy? I don't think so. Europe has been a mess for a long time. Japan has been dead money for 30, 35 years. It's now had some sort of a resurgence now because of some massive changes taking place in Japan. So, if you have this situation where the US has been, the center of all the innovation, and we are now in the digital era, we've been in the internet era for 20 plus years, and now we are moving to the AI era. And which country basically dominates in this area is the United States. Most of the innovation happens in the US even now. And that's why investors are voting with their cash. And they're saying, you know what, we would rather pay up for excellent businesses in an excellent economy, which is governed well, rather than trying to look for bargains in countries or in jurisdictions where we are not certain about the corporate governance or the political governance, where things could blow up or laws could change or anything can happen overnight and we end up losing a lot of money. So is the US expensive? Yes. Is it justifiable? To some extent, yes. So the question really is, what has been priced in? And I think if you see what the indices have done over the last 12 to 15 months, we've had this huge run up in the mega caps. So, the gains we've seen at the index level have been powered largely by the mega caps, the techs. If you look at the Russell 2000, the IWM, if you look at the Russell 2000 growth, which is IWO, if you look at some of the other indices, they're all sort of flat. They're not near their all-time highs. A lot of the growth stocks are still down on their knees simply because the Fed has been doing QT. The interest rates are, above 500 basis points, 525 basis points, or somewhere in that region. And the monetary conditions have been fairly tight. And that's why, the money has been flowing into the safest areas, which is these days the mega techs, because they are cash-rich, highly dominant companies at the forefront of AI, and they are going to benefit from this AI because they have the resources to compete. They have the data. They have built out their data centers and the infrastructure. If you're a startup, it's very difficult to spend, billions and billions of dollars building out your infrastructure, which you will need for the AI, and you don't have the data. So, with this emergence of AI, I think, the mega caps, the mega tech companies have become even stronger. And I think, AI is a game changer. It will basically disrupt pretty much every industry in the world. I don't think this is a passing fad. I think it's a mega shift in, the tech space. First, we had the internet revolution. Then we had mobile when the iPhone was announced by Steve Jobs many, many years ago. Then we had cloud computing, where the workloads gradually started moving to the cloud from on-prem, and now we have the AI era. And so far, if you look at what's happened and what's worked, it's been these AI-related plays, which is the FANG stocks, the Nvidias of this world, because of the infrastructure build-out. But the participation hasn't really filtered through to the rest of the market. For sure, many companies have gone to all-time highs, but still a large section of the market is still pretty weak and nowhere near its all-time high. So it is a bifurcated market. It has been like that for a while. And I think, if the Fed basically starts cutting rates later this year, then, you will see a big broadening out of the rally, and these high growth stocks, which have been really, put under the pump because of high interest rates and QT, are going to really start to shine because they've been building massive bases for the last 2 years or so, 2.5 years. And history shows that whenever, the stocks of amazing companies go sideways for such a long period of time, for whatever reason, as soon as those situations, basically the conditions change, these stocks go ballistic. So I still think that, with the slowdown or in the taper in QT, which is starting in June, the Fed has basically reduced the QT every month. So they're going to be easing monetary conditions starting June. And then if they start cutting rates, when the economy weakens and if the unemployment starts to pick up, I think interest rates are going to come down. And that is going to basically, in my opinion, ignite a big rally in these high growth stocks, which have basically been dead money for the last 2.5 years. And if you look at the valuations now, the valuations are not overly egregious or expensive. So if you look at, a stock like Zscaler, which I basically own shares of, is now trading at 10 or 11 times revenue, which isn't a lot. A lot of these companies, which I'm actually investing and we are focusing on at Alpha Target, they are not currently GAAP profitable, but they have a lot of free cash flow generation. So the free cash flow margins are 25, 30, 35, 40%. Monday.com, which is another portfolio holding, announced 41% free cash flow margins, and their free cash flows are growing like crazy. So, in the long run, statistics have shown that, business growth or the growth in revenues, free cash flows, and so forth, this has been responsible for the vast majority of returns for shareholders and investors. It's not changes in valuations. Valuations have a big impact in stock prices, performance, and movements over a 1 year period. But if you have like a 2, 3, 4, 5 year time frame, then the changes in valuations don't really mean much. What drives stocks over the long run is business growth and durable business growth. So those are the sort of areas that we are focusing on at Alpha Target. And we are of the view that if interest rates start to come down and monetary conditions ease, then you are going to see a strong rally in the back half of this year.
All right, I got a question, and then I'm going to see if my co-host Doc Mark uses any questions, but I'm actually going to ask a question for him first, and that is Apple. Really want to get your thoughts here on Apple, which for so long was the market leader, right? Was the top stock, seems to have taken a backseat first to Tesla, then to Nvidia. And at this point, Apple's being hit with accusations of they don't innovate, right? It's just the same phone coming out. And there's a stock that continues to churn pretty much to all-time highs, but people don't seem as excited about. What's your thoughts on Apple here?
Well, Apple, in my opinion, is no longer a growth company, because if you look at their revenue growth rates year over year, they're not growing at a very fast pace. Apple has transitioned into what Peter Lynch used to call a stalwart, which is basically a big, mature blue chip with a strong balance sheet. Is not going to set the world on fire. It's not going to grow 20-30% a year unless they come up with something, really world-changing. They're already too big. I mean, their focus, I think, now is just to maintain the fortress that they've built, and basically to keep compounding their cash flows and their earnings per share through share buybacks and dividends and stuff like that. So it's a mature company. It's not an exciting growth company. It was 20 years ago. I mean, some of the other names also, in the FANG space, they're no longer growing at 20, 30, 40% a year like they did in the 2000s. So these companies were yesterday's, winners in terms of their growth rates. They were the secular compounders from the last 15, 20 years. But, if you're looking at outsized returns as an investor, you're not going to get, 20, 30% annualized from owning these shares, because the whole world knows them by now. And, their revenue base is already so large, it's going to be very hard for them to keep growing at a very high pace. It's just mathematically not possible. So that's why I think investors, in my opinion anyway, will, if they're looking at higher returns, really need to, dig deep and do the research in the next generation, younger growth stocks, which is what we are focusing on.
Got it. And then I suppose in a not so dissimilar vein, but maybe one that is continuing to really expand now, we have NVIDIA earnings tomorrow. What's your expectations going into earnings?
Well, I think, it all comes down to what the company guides. And I think what the street or the big institutional players really read between the lines, because I would be stunned if NVIDIA doesn't beat estimates tomorrow, because, there's just so much momentum in the business. And if you see what the big FANG stocks have said in their earnings releases and their earnings calls, that they are still going ahead full steam with their capex build for the data centers for the AI space. So I think the earnings are likely to be good and strong, but I think the big buy-side analysts and the institutions are going to be looking more carefully at what the company says over the next 12 to 18 months in terms of guidance and where we are in the cycle, because I think everybody is trying to figure out, where we are in this capex cycle. How long is it going to go on for? Is it going to go on until the end of the year? Is it going to go on for 12 months, 15 months? And I think that's where the question mark is. And if NVIDIA somehow sends the message that, there is even a whiff of a slowdown in their future orders, or some of these big buyers are pulling back, the stock's going to not react very well. On the other hand, if everything is fine and NVIDIA still comes out and raises their guidance for 2024 and says, business is still strong for as far as the eye can see, we could have a little bit of a pop, but it's just very difficult to know what the stock's going to do. As these days, stocks move up and down 15% within minutes, and then they reverse very quickly during the main session. So I think that the risk reward in NVIDIA at these levels is not very favorable. I've reduced my position by 40%. And, if we do get a big sell-off in NVIDIA, I'll probably establish a full position again. If it goes up, I'm not going to chase it. In fact, if it keeps going higher and higher, at some point, I'll be looking at cashing in all my chips and moving to the sidelines before, we get the stage 3 top and stage 4 decline.
Got it. And I'm going to throw one more question here, and then Evan, I'll bring you in. And that is a stock that I believe you're currently long. And I actually thought this was really interesting. And I saw your bull thesis for it. It made sense to me, which was Duolingo. If you could break down your thesis there.
Yeah, for sure. I mean, Duolingo, I first basically was recommended this by my teenage children, believe it or not. You know, they said to me, "Oh, do you know what Duolingo is?" I said, "No." Yeah, they said, "Oh, you boomer." I said, "Look, I'm not a boomer. I'm not that old." But they still, said, "You must know what Duolingo is, Dad." So I said, "Okay." So I basically played around with it for a few months, and my kids said to me, they said, "Oh, we've been using this, and all our friends and stuff use this these days." So I played around on the app just to try and learn a little bit of Italian and French. So I spent a few weeks on it, and I was amazed at how addictive it was, and how interesting it was, and how good it was. So I just looked at the numbers then. So I looked at the product first, and then I spoke to people, and everybody I spoke to was raving about Duolingo. So I did the homework, and I looked at the company, found out about the founder, Louis von Ahn, looked at his background, where he came from, what he built, his history, and everything else, and then saw, what the company was doing in terms of financials, and the growth rates, and how quickly the user base was growing, and so forth. So I became interested in the business. I invested in the company. The stock's done well. It's come off a little bit based on the AI fears because of the translation, features which AI, LLMs and stuff will introduce later on. But I think the stock, in my opinion, is probably close to a near-term bottom. It's near its recent lows, which were recorded in early this year. In terms of the business, would I say, is it a super high conviction holding for me, given what's happening in the AI space? Probably not. I would say it's a medium to high conviction. It's not, like a slam dunk, like a Snowflake or a Mercado Libre, where I, know for sure that 5 years from now the companies are going to still be around and thriving. So, Duolingo, I would say, is a mid to sort of high range conviction, and I'm watching it more closely than I am with some of the other holdings. But I still think that the AI fears, at least for the near term, are overblown, simply because just because an app or a service can basically translate something instantaneously in human language doesn't necessarily mean people all over the world are going to stop learning new languages. I mean, if you are an American, for example, and your native language is English, and if you want to go and learn, if you want to go and live in South America, or if you want to go and live in Spain, or somewhere in Europe, you would need the local language, and you're not going to walk around with your mobile phone in your hand, asking for prompts from Chat GPT to have conversations with people. That's not how humans work. To have deep, meaningful conversations, both in the business world and also at a personal level, you need the local language. And I think a lot of people are naturally curious, and they like to learn languages, interact with people. So I don't think translation services are going to change or totally damage Duolingo. We've had translation, Google Translate, for a long time, and that hasn't stopped people from learning new languages. I think people enjoy learning new languages and interacting with different people from different cultures and so forth. So it's not, I wouldn't say that this is a slam dunk conviction for me. It is a mid to high, somewhere in that range, and I'm watching it closely. But I still think that the CEO is a genius, and what he's built reminds me somewhat of what Match.com built on the dating side of things. It's a consumer app. It's growing like a weed. People like it. The metrics are very good. The free cash flow generation is there. The revenue growth is there. I can't really fault the company on any of the operating metrics at this stage anyway.
Yeah, I'm a big fan of it as well. I do use Duolingo every single day. And I think that, one, they actually are using AI inside their app. They have some AI features as well, which is cool that they're integrating that. Number two, I don't really think I agree with you that other companies having an AI product is not going to be the reason that people don't try to learn a language. The reason that I use Duolingo is because I'm moving to Puerto Rico. And in Puerto Rico, everybody pretty much speaks English, but they like it if you could speak Spanish, right? It's
Right.
helpful. And there's certain areas where you are just going to want to speak Spanish. And like me taking out my phone and using that to translate does not make them happy, right? Like
Exactly.
I'm learning it to be able to engage with the culture. And in fact, one of the biggest reasons that I actually tried to learn it, and this will completely disprove people's thesis of other AIs, is My second night in Puerto Rico, I ended up in the emergency room
All right.
taking care of my girlfriend. Yes, second night. And we're in there, and the nurses do not speak a lick of English.
Right.
And they hand me the paperwork, and it's all in Spanish.
Right.
I don't speak any Spanish.
Right.
And they're just yelling at me. They only know one word in English: sign, 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 right?
Right.
And they're just yelling at me. I'm like, oh my gosh, what am I signing? So I take out my Google Translate, but guess what? There's no service. So all of a sudden, my Google Translate's useless, right? Because I just didn't have it in my brain. So for me in that moment, I was like, I got to learn the language. I can't actually count on a separate app. So I completely agree with you there. All right, Evan, do you want to throw a question or two into the mix?
Yeah, I think you've done a great so far on this, a great job on the Spaces, Wolf. So I'm good to just hang out and chill back. And Prue, I've appreciated the conversation here. Duolingo is definitely an interesting one. I said that weird, and I know it, but I'm just going to keep moving on. We'll see how all these kind of LLMs, my small LLMs on your phone, ends up changing that stuff. But still a little bit a long way from that one. You did mention this stock a little bit while you were talking. Another major company that reports earnings tomorrow. That's going a little bit under the radar because its name is not Nvidia, but I would love to hear your thoughts on Snowflake. I know it's a name that you own. I've seen you tweet about it a little bit, but I would just love to hear your thoughts around Snowflake, kind of those numbers we have tomorrow. It's obviously a big change there with a new CEO. Hopefully some sandbag numbers that they can come in and beat. We'll see that tomorrow, but I would love to get your thoughts on Snowflake from the perspective of earnings tomorrow, and then just in general, your thoughts on the company.
Well, I think Snowflake is a dominant business, and I think it's going to do very well over the long run, simply because of what it does. The data stuff, data warehousing, data lakes, and so forth, and data analytics, and also AI. I think is going to benefit Snowflake. And if you look at the new CEO's background, he has an AI background. I mean, he scaled Google's business significantly at his time as Google. And I think Frank Slootman stepping down is probably the right thing for Snowflake at this juncture, because Frank Slootman is not an AI specialist. I mean, he's a very strong executive, but the new guy who's joined, the Indian fella, he has a very strong product background. So I think he's been brought on to basically, lead the innovation in Snowflake at the AI level. And people tend to forget that Snowflake is also a consumption-based model, pricing model. So, because of the slowdown and the tight monetary policy, most of these software companies which are consumption or usage-based are actually going through a sort of a business slowdown. If you look at Datadog, you look at Confluent, you look at Snowflake, all these companies, the growth rates have come down because usage has come down. I mean, we've come down from peak usage during the COVID pandemic, where everything was booming for these companies because of, the drive towards digitalization at the enterprise level. And then you had very loose monetary conditions. So everything was working, the economy was booming. So we're not at that phase of the cycle right now. We are at a phase of the cycle where things are tight, money is tight. The business is not as fast and robust and not growing as fast as it was before. So multiples have contracted. And if my worldview is correct, I think if the economy basically holds up and if the Fed starts easing, then the usage rates of these software usage consumption-based companies are going to accelerate in the future. And the multiples have come down enough now because of tight monetary conditions and high interest rates that if things basically pan out as I think they will, then the shareholders are probably going to capture all of the business growth, if not most of the business growth. Because if you buy a company which is trading at a very rich multiple, even if the business grows because of multiple contraction over a number of years, shareholders don't actually capture the entire business growth. But if the starting valuation is low or reasonable, and if the business then compounds at 20-30% a year for a number of years, then if the multiple remains more or less the same or even contracts a little bit, then shareholders are able to capture nearly all of the business growth, which is an ideal scenario. I mean, ideally, you want to buy into great companies when they are super cheap, because then you benefit not only from the business growth, but also from multiple expansion. But that's very hard to do unless you are in an outright nasty bear market or in a nasty crash of some sort. Generally, if you invest in solid, durable companies and you pay a reasonable multiple, or even if you overpay a little bit, you do just fine over the long run. What you want to avoid is, overpaying silly amounts of money, multiples for fast-growing companies, because then you get smashed. So coming back to your Snowflake question, I think, the near-term guidance may actually prove to be too conservative. I think the company did that to make it easy for the new CEO to transition into his new role. So, shareholders don't get disappointed by him. I would be very surprised if Snowflake doesn't actually beat and raise during this upcoming earnings release. And I think if you look at the chart also of the stock, I mean, the stock appears to be forming some sort of a bottom. So I wouldn't be surprised at all, if we do get some excitement after the Snowflake earnings. If anything, even if there is not much excitement, I'd be very surprised if the stock goes much lower from here.
Appreciate the thoughts.
All right, I will jump back in. I feel like there's one stock that we haven't talked a lot about, and you have posted recently about, which is Tesla. And we had a conversation about Tesla earlier today. And while other stocks are setting all-time highs and multi-trillion-dollar valuations, Tesla has definitely lagged. What's your thoughts on it?
Well, Tesla is a cyclical. I've been saying for years, and people didn't believe me. Now they can see it with their own eyes. I mean, you look at the year-over-year growth rates of Tesla. They're not growing at 30% anymore. Their business is struggling because of high interest rates. It's an auto OEM. It is an innovative technology company with its pies in many, many different, its fingers in many, many different pies. They've got, the auto side, you've got the energy storage business, the battery business, the supercharger business. Then you've got the AI side. They are sitting on a huge amount of data. You have the full self-driving, autonomous driving, robotaxi optionality. And then the thing which really excites me with Tesla is actually the Optimus, the humanoid robot business division, because I think that has the potential to actually become far bigger than all the other businesses put together. And I think, at the moment, the street is worried. Investors are worried about Tesla. They're valuing it as an auto OEM. The business results haven't been great because of, the slowdown in the auto business due to high interest rates. And this is a completely normal cyclical drawdown in the industry. I don't think the world is going back to petrol cars. If anything, I think the transition towards EVs is going to accelerate in the future, because the costs of producing these things are going down. If you look at what's happening in China, I mean, they've come out with a $25,000 or $30,000 EV already, BYD. And I think the prices of these EVs are going to go down, as what happens with any new technology. The price goes cheaper and cheaper and cheaper. And then you're going to have the S-curve adoption for EVs. And it just makes sense. I mean, the fact that we still burn fuel and, pollute the environment is nuts in today's day and age, where you can actually generate the power you need from solar energy, in a renewable, much more sustainable manner. So I think, EVs are going to stick around and they're going to become more popular. I don't think this is the end of the EV, transition. We have a long runway ahead. I think Tesla is the leader, at least in the Western world, in this space. BYD is a big, formidable competitor in China. But if you have protectionism in America, like we're seeing now, Biden talking about imposing hefty tariffs on Chinese EV imports and so forth, then I think Tesla is going to have some sort of, protection in the Western world, at least, to continue to grow. And I think Tesla is also going to come out with cheaper models over time. They're working on it now. But I think the real reason why I've invested in Tesla and why it interests me is the robotaxi opportunity, and much more importantly, the robotics as a service, RaaS opportunity. I think, FSD has been very painful for Tesla shareholders, because Elon, I think wrongly, has been promising full autonomy for 10 years now, and he's basically dented his reputation and credibility somewhat because of that. But most people don't realize how difficult full autonomy is. Full autonomy is not easy, because you have to take into account a factor in every possible eventuality, and you have regulatory hurdles that you have to jump over, and you have insurance hurdles also. If you have a crash, and imagine if there's a human driver, and if you have a fully autonomous Tesla, if somebody dies, who do you think is going to cover the insurance? So, these are some of the questions which the insurance companies must be asking themselves now, and the regulators must be thinking also very carefully before unleashing this technology in the wide open space. Because if there are fatalities and accidents and so forth, who's going to take responsibility, both, morally and legally and financially? So, this is a long process. I think personally, full autonomy is still several years out, maybe 7 or 8 years out. Maybe that's a 2030 story. But I think Tesla has a real opportunity here to monetize its humanoid robotics segment, simply because if you have an army of robots working in a factory, even if they kill each other, they're not going to kill human beings on streets, not at this stage anyway. So you don't have the regulatory overhang, you don't have the insurance issues to worry about. And I think Tesla has the capability and the capex capability. If they want, they can raise capital from existing shareholders or borrow from the bond market. And I think investors will fund this, because I think the unit economics of this business are likely to be pretty impressive, because it's not going to take them much to build a bot. And instead of selling the bot, if they actually lease an army of bots to companies all over the world and charge them an hourly rate, for instance, or a daily rate, which is 30 or 40% of what the labor costs are for a human being. If you are a factory owner, or if you own a big organization, and suddenly you can cut back on your human resources costs by 50 or 60%, or you don't have to then suddenly worry about human behavior or sick leave or annual leave, or women getting pregnant and going away and not turning up to the office for 3 months or 4 months or whatever, maternity leave, paternity leave. And I have nothing against women getting pregnant and taking time off. I'm just giving you an example of how a business owner might think. Suddenly, if you can cut your human resources costs by 50, 60% and eliminate all these issues which come with human beings, who wouldn't do it? I mean, most companies would jump at the opportunity. You can see that happening already. If you go to McDonald's or any other stores around, in the fast food space, you can see that the ordering machines have already taken over. You have a massive, gigantic screen. You just place your order there. You don't have a human being taking orders anymore. In Hong Kong, you have, juice bars and coffee shops, and milkshake bars, which actually are run 100% by robots. So you go there, you place your order on a screen, you stand and you watch as the robot basically dances around with its, robotic arms, puts together your order, it comes out on a conveyor belt, and you're good to go. You don't have human beings. So I think that is a big opportunity. And I can see, a world where these robots are going to displace human beings, and at least initially for the repetitive, dangerous, mundane tasks, which nobody wants to do. And also there is a labor shortage, don't forget, in the Western world. So this is a big opportunity. And eventually, just like people nowadays, walk around with computers in their pockets, which are the smartphones, I can see or imagine a world, 5-7 years out, where everybody has a little, family robot initially to help out with the family chores, vacuuming, mopping, cleaning the windows, cutting your vegetables and stuff like that, ironing your clothes. And eventually, just like any technology, people would maybe even want one per person. When computers came along, people used to have one desktop in a family, and then the smartphones came, and then people had their own smartphones. Everyone had their own computer. Now everybody has 2 or 3 devices, a desktop, a laptop, an iPad, a phone. So it could be, in the future where people have their own robots. And, even if Tesla sells those robots to those households, I think the opportunity on the commercial side is so enormous, because the gross margins on this business are going to be massive. And this is going to generate a very high margin recurring revenue business, because the cost of upkeeping these and maintaining these robots is not going to be very high, and yet companies are going to be happy to pay the prices at a 20 or 30 or even 40-50% of the cost when compared to human resources or labor costs, because it'll be cheaper for them and they can work them 24/7. They don't have to pay or worry about overtime or lawsuits from human resources lawyers and so forth. So I think, this has the potential at least to be a ginormous business down the road. And that's why I've invested in this. And if we get full autonomy and a robotaxi fleet, or, significant revenues from services on the FSD side, all well and good. That's the cherry on the cake. But I'm primarily invested in Tesla for the robotics opportunity.
Yeah, Evan, do you want to comment on that? Because when we do Tesla Spaces, that seems to be the thing that you're very, very focused on.
No, I think it's an interesting one. I'm very excited by the FSD aspect of it. I still struggle to get my head around the whole robotics AGI version of it, but kind of the more use case in a factory. I've kind of seen Amazon, invest heavily in this area as well. Is something that I very much could get my head around over the next couple of years. So my question would be around some of the other companies that you think might be kind of implementing those robots. I mean, Amazon is the one that comes first to my mind, both with implementing the robots, but also a company that could use them heavily in their warehouses with a lot of repetitive tasks. At least the first version of these robots that are kind of well, the first versions have probably been out there for a while, but I'm not talking about the AGI, it can do anything robot, but more the factory workers ones. What kind of other companies are interesting for you in that area? Amazon's the first one that comes to mind, but I wonder if it's kind of just, I don't know, too big to be able to single out for that specific part of
I
it.
mean, Boston Dynamics is a company which I've been watching closely. It's majority owned. I think 80% it's owned by Hyundai Motors in Korea. SoftBank, if I'm not mistaken, I may be wrong, but last time I checked, SoftBank owned 20%. So they are also a pioneer in the robotics space, Boston Dynamics. And then there are a number of startups in the private markets which are also developing or have developed their own humanoid robots. Aptronic is one. There's a few other ones as well. So this industry is going to be massive, Evan. I don't think this is going to be a small industry. So I think it's not a winner-take-all market. I think there will be several players. But I think where Tesla has an advantage is that they have the scale and they have access to capital and they have the manufacturing prowess and they've got the mad genius at the helm running this company. So, it's going to be very difficult. Not impossible, but it's going to be much harder for the startups to compete in this space simply because they don't have access to the capital. They don't have the existing manufacturing base and the brand, So over time, do I see multiple winners in this space? Absolutely. Will Tesla walk away with the entire market? Absolutely not. But if the market is, worth several or tens of trillions of dollars, then, Tesla could definitely get a big chunk of that pie, and it's going to be very nice, juicy, high margin recurring revenue.
What do you think needs to happen for the market to start maybe pricing in that possibility? Do the robots and everything like that need their own ChatGPT moment where the market goes from not thinking AI is real or anywhere close to maybe starting to price it in? What are you kind of looking for the market to start kind of, I'll say, respect Tesla's Optimus project, but really just start kind of price it into their models?
Well, I think they will have to produce or strike some sort of commercial deal with one of the companies to actually show that they have a viable product which actually works and does the tasks which it would basically need to do to demand or command that sort of recurring revenues from these big companies. So as I said, FSD to me is more difficult to wrap my head around, at least in the near term, because of the regulatory and insurance risks I just highlighted. I think that's a more longer term story. I do think that robotics are likely to basically commercialize within the next couple of years, 2 to 3 years. I think the market has started to get a whiff of this, and that's why Tesla stock has bounced a little bit over the last few weeks. And I think there's a lot of anticipation now with what Elon Musk is going to discuss when he, unleashes or unveils the robotaxi venture later this year. So, these are some of the things to keep in mind. I still think that Tesla has the potential to maybe, be a 6 or 8x, 6 or 8 bagger over the next, 8 to 10 years. Simply because if the robotics as a service business division commercializes and scales, and you have FSD being licensed and eventually their own robotaxi fleets down the road, this is not going to be a 15 or 17 or 18% gross margin business. This is going to be a very high gross margin, high operating margin, recurring revenue business. And I think at that point, or even before that, when the market gets whiff of it, Tesla's stock is going to start to re-rate.
Hey, I'm looking forward to it. I'm for it. Tesla's a top 5 holding for me.
Likewise.
I appreciate it.
Okay, cool. Puru, we've been running over an hour here, and I know that the plan is to do these monthly, so probably don't need to keep you too much longer on here since we'll be running them more often. But I did want to give you a chance. There are a lot of people in here that were not in here in the beginning of the space. Could
Right.
you, for one more time, maybe give us a few minutes on Alpha Target and what you want people to be paying attention to there?
Yeah, for sure. I mean, Alpha Target has been, I mean, the reason why I've set this up and basically come out of retirement, the motivation behind this has been, the countless requests that I've received over the last few years from followers from all over the world asking me to do something for them, launch an ETF or manage their money or, provide some sort of research service. So I thought about this long and hard. I'm mindful of the fact that, we don't want to, we have to tread a fine line here because we want to, give retail investors access to high quality research offering, which is, at par with institutional grade research or slightly below it, because obviously we don't want to get too granular and complicated and confuse people who are not investment professionals. But we want to produce a very high quality service where we research and find the most promising, disruptive, rapidly growing companies. We invest our own capital in those companies. We share our investment holdings with our subscribers. We publish in-depth, high-quality research, both qualitative, quantitative, and technical research on those holdings, which will be available in the form of monthly reports on our website. And then we will basically give people the tools and empower people to basically invest their own money. So we will share our proprietary hedging indicators, which I have formulated after months and months of backtesting on a quant software. So we will share those signals with our subscribers in real time, so they can basically see when the market is in an uptrend, when it is in a downtrend, and then they will know when we are hedging our portfolio, when we are removing the hedges, and then investors and subscribers can then decide for themselves whether they want to do that or not themselves. That's going to be entirely up to them. When we buy and sell into new companies, we will send out alerts and a full write-up, a big equity research report saying we're investing in this company and these are the reasons why. These are some of the risks. This is what the operating metrics look like. This is what the financials look like. This is what the technical picture is. This is the management team. These are the top shareholders. This is the company's overview. This is the competitive advantage or advantages of this company. This is why the competitors can't compete with this company. So it's going to be a comprehensive offering. And then in order to keep people up to date with the holdings and with what is happening in the markets and in the company side and the industries, we will also put out weekly updates, which subscribers will receive on every Monday, which will basically cover a brief overview of what's happened in the stock market over the last week or so, what is happening at the Fed, what is there any company news flow from any of the portfolio companies? Has any of the competitors announced anything which has basically caught our attention? And when the companies release their earnings, then our analysts will put together analyst research notes, a full summary with our interpretation of these companies' earnings releases, and we will share all of that on a Monday morning. So it's going to be a full offering. It's not just like a deep dive a month run by some Substack writer sitting at home or whatever. It's going to be a team of dedicated investment professionals. And we are also going to subscribe. We've already subscribed to institutional grade data feeds and also institutional quality research, which is not cheap. So if any retail investor tries to do this themselves, the cost of doing this is going to be thousands of US dollars a year. And we are going to offer this at a reasonable price point. We're not going to be priced at the Substack level, but we are still going to, give it at a reasonable, cheap price point, which is it's affordable and accessible to the vast majority of people. So we haven't really finalized the exact price point yet, but we've actually had discussions with a number of people, and we have a fairly good idea of what the price point will be. It's not going to be, over expensive, because as I said, the reason I've done this, the mission of the company is to actually empower investors at the retail level and give them something which is not normally accessible to them. If you look at some of the other offerings at the retail level, You know, a lot of these guys and services do good research. You know, they have very good deep dives and stuff, but there is no portfolio management angle. There is no risk management strategy. Nobody tells their subscribers when to buy, when to sell. There is no technical analysis. There is no hedging and so forth. So, you know, what I'm trying to do is give people the tools and the information and the knowledge so they can actually, you know, find a good resource or a good source where they can actually, you know, come in, they can see that we've done our homework. You know, our team of analysts has done the homework. We've selected the very best companies we can find, and we've invested our own capital in those companies. And they will know that, you know, when they subscribe to our research, they will know that our own skin is in the game. And when we make any changes to our portfolios, we will share those details with them in real time. So, you know, they're not going to be left hanging to dry if we make, you know, changes to our portfolio. When the stock runs up too much, we will send out an alert saying, look, we've raised some cash in the account. If the stock comes down too much, we think it's become cheap. If we are adding, we will again send an alert saying, look, the stock's come down. We think the valuation is low. The stock looks attractive. Technically, we are adding to our position. So it's going to be a portfolio management tool. Hopefully, it will give people at the retail level the confidence and the, you know, knowledge and the resources of how to do it themselves, so they can actually run their own portfolios from the comfort of their own home, rather than giving their money to some advisors or, you know, managers who underperform the index and they pay through their nose for it. I mean, just to give you an example, guys, you know, if somebody has a $200,000 portfolio, and if they are paying, you know, 1.5% to a manager, or 1%, you know, that's $2,000-3,000. If you're managing $1 million portfolio, 1% is $10,000 a year. 1.5% is $15,000 a year. We're not going to charge, you know, at such levels. We are going to make it affordable for people. You know, come in maybe around the $100 mark per month, or $1,000 or something along those lines. I'm not sure. I mean, I know I can charge more. I know similar services in the market with people who are basically have the same level of experience that I have, or even less. Some of them are charging $2,000 or $3,000 or $4,000 a year for a similar service. But, you know, as I said, money is not the only motivation why I'm setting up this business. You know, I'm doing it genuinely to sort of empower investors at the retail level. So if I have to price it lower at a, you know, $1,000 US or $100 a month price point, then so be it. You know, if the word spreads around and everything else, and if you're doing a good job, the business will take care of itself. But, you know, I mean, we had a few comments before. People were saying, you know, but, you know, this Substack writer sells it for $20 or $50 a month, you know. But the thing is, you know, you have to also look at who's publishing the research. You know, we're going to have our own dedicated world-class website, and we're investing a significant amount of resources in building this platform properly, you know, website, software, IP, intellectual property. I'm putting together a world-class team of analysts from different, you know, genres, different aspects of the business, qualitative as well as quantitative. I mean, one lady who has joined us now, she's Malaysian. She used to work at Citibank Malaysia. She's worked at brokers before, a brokerage firm as a sell-side analyst who was basically affiliated with Jefferies. And she knows, you know, how to do the quantitative modeling and so forth. And, you know, we've got two guys who have already signed up. One is, you know, Steve Symington. He worked at the Motley Fool for a number of years. He worked as a lead advisor at Seven Investing. I mean, this guy has been working as an analyst for over 10 years. I mean, I'm very happy he's now part of the team. He does exceptional qualitative research. And I've also, you know, recruited another guy who's deeply knowledgeable in the tech space. And he is also a very experienced analyst. He's going to join us a few weeks later. And as I said, I'm in talks with another buy-side analyst from a massive hedge fund. He's just retired from the hedge fund. He's, you know, 15 years of experience. He used to write institutional-grade buy-side research reports for his multi-billion-dollar hedge fund, and he used to also be a portfolio manager running his part of the portfolio. So we're putting together a very high-class team. You know, for me, I've been in the business for 25 years as a professional money manager, 15 years, founder of 2 SFC-regulated money management firms and so forth. So, you know, we are going to provide something truly different and hopefully useful for our subscribers. So, you know, obviously we're not going to price it at the same level as a Substack writer who does a deep dive at $20 or $30 a month. We have, you know, overheads to cover, and we have to price it according to what we are offering. And I do believe we're going to offer something truly useful, and it's not going to be overly expensive. It will be within reach for most people with, say, $100,000 portfolio or higher.
Love it, Puru. I appreciate it. Wolf.
Hello?
Yeah, I got you. Wolf was having some connectivity
Okay.
issues there. I was thinking he would be able to hear me, but no, I heard all that. I think everyone down below did. Puru, we really appreciate you coming on here. This was a really great conversation, and just as I said that, I just got a notification at the top saying they're having some connectivity
Right.
issues. But I think this was a really great time. I learned a lot. I really enjoyed these, and it's really nice to hear that you guys might be doing this as a monthly thing.
I mean, I'll
So
do it.
that is pinned up
I've
in the
mentioned
mess-
to Gav that I'm going to do this every couple of months. So not monthly,
Love
it's
it.
going to be every 2 or 3 months.
But that's pinned up in the nest above. So if anyone wants to go in and see more about Alpha Target, some of the stuff that Puru is working on, that is pinned up there, and you guys should definitely go in and check it out. And
Yeah, I mean,
I know
we're
I
hoping
am,
to
so-
launch the website towards the end of the month. So I will basically confirm the exact
Ooh, very
date soon.
exciting.
I'm just discussing the exact launch date with the web developers in London, who've basically spent several months putting up this website. So hopefully, it would be a fantastic website and a fantastic offering which people would benefit from.
That must be fun being in Hong Kong and then dealing with people in England and then talking with people on the East Coast. Must be a fun.
Oh, it's not really fun because, the time difference. They call me at 11 o'clock at midnight my time, so I'm sleeping like an owl these days.
Totally fair. Well, Puru, thanks so much for taking the time, spending it with us. I think everyone got a lot of education out of this. I always enjoy listening to you speak. A lot of wisdom there for us to pick up on. Looking forward to the next one. We'll talk with you in the DMs.
All right. Thank you very much, guys. Always a pleasure. And thank you, everybody, for tuning in. I hope you found it useful.
Have a great rest of your day, Puru, over there. To everyone else on the East Coast with us. Tomorrow, I believe Evan will be having a space in the morning that people can hop in and check out. I think so. And there'll be some live trading, and we'll have some more stuff midday that I'll be a part of as well. So thanks again, everybody. Have a great evening. Take care, Puru.
Thank you very much, guys. All the best.
Appreciate you guys. Great talk. See you all later.